don't know what affects mortgage rates, well, this might be the video for you. Hi, my name is Matt Coach. I created this YouTube channel to share the tips, tricks, and mistakes on my way to building an 8-figure real estate portfolio. And if you guys heard about rates getting cut, and now interest rates are starting to creep up a little bit again for mortgages, well, why does that happen? If the Fed hasn't cut any kind of rates or anything, what's going on? Well, mortgages are based upon the 10-year Treasury yield, right? And the 10-year Treasury yield has a component of supply and demand to it. So the 10-year Treasury is determined by, lending. So when the Federal Reserve lowers the prime rate, all loans, get lowered. So that does affect the 10-year Treasury yield, the 10-year bond. But there also is a supply and demand factor to it. So when people are uncertain about the economy, they tend to move their money outside of stocks and into bonds. When they move their money into bonds, the bonds lower. So if there's more of a movement out of the stock market into bonds, if that happens, then we can see rates lower even more. But if there's an opposite effect, where the Federal Reserve cuts rates and then there's more money that gets thrown into the stock market, you might not see as big of a change into that 10-year bond. So understand that there's both. This is why, during COVID, when the Federal Reserve had really low rates, we also saw even lower mortgage rates because there was so much uncertainty inside the stock market that people were moving their money into bonds. So we kind of got hit on both sides, that they had really low reserve rates so that borrowing money would be a lot easier so that they could keep the stock market going. But because there was so much uncertainty inside the stock market, still people were moving money into the bond market. So if you're ever wondering how real estate boomed when there was, COVID going on and people couldn't even live in houses or pay their rent for a lot of these houses, that's why. Because real estate tends to follow with the bond market. Lower interest rates, more borrowing. Real estate's all about borrowing, so there's a lot more turnover that happens inside the market. So on top of that, there's also a thing, your mortgage spread. So you have a loan servicer. So when you go to Wells Fargo to get your mortgage, they sell that loan to a loan servicer who takes your payments. So that loan servicer pays some amount to Wells Fargo. That's how Wells Fargo makes money on these loans, right? So when that happens, right, they need to see a certain spread on the loan to be willing to buy it, right? So when rates are very high, the loan servicer has a really large chance of that loan getting refinanced, right? So that inherently makes it a more risky loan. So when rates are higher, they also want a higher spread. So you get hit on both ends when mortgage rates get higher, because they also know that you're less likely to keep that loan for a very long extended period of time. So when mortgage rates are very low, they also want a very small spread. This is because they don't think you're going to refinance. They think that you're going to probably want to live out that whole 30-year term because you have a 3% interest rate during 2021. And you're probably not going to see that again maybe in your whole life. So that is why mortgage rates move the way that they do. So a Federal Reserve rate cut doesn't necessarily mean that mortgage rates will go down, although it very, very typically does. And if they do go down, you usually see a double hit where they go down not by so much as the half point that the rates got cut, but by more than that, because they're less likely to refinance the loan. Now, if the rates cut, but for instance, there's a very, 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 very good chance that they're saying, hey, the rates are going to keep getting cut, then you're going to still see a big spread, right? Because this is still a very risky loan. So if they think that, hey, this is the bottom of what rates are going to be, and they're going to start going up again, or they're going to stabilize, right? Then they're going to have, a normal spread for it because they're not going to, or a smaller spread for it because they're not expecting you to refinance anytime soon. It usually takes a loan servicer about 7 years to break even on their loan. So that's the calculation that they're trying to do, is how many people are going to refinance. They have all these numbers, all the statistics or whatever, how many people are going to refinance to where that they hit their profit margin, because the average mortgage is about 7 years. So hopefully that wasn't too boring for you guys, but there you go. That's why mortgage rates move the way that they do, and why you might see, hey, mortgages jumped up a half a point, and like your mortgage might go up a whole 1%, because they say like, oh yeah, well, this is the height of where mortgages are at, so you're going to want to refinance, within the next couple years. This is also why they have like prepayment penalties, so that they can collect their interest. So there you guys go. Hopefully that was helpful information for you guys. See you later.